Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today I want to go over a couple things. It's mainly dealing with, I know there's a lot of people that are afraid of a recession. They think that it's going to kill demand and that things aren't going to come back and that the thesis, or not really the thesis, that commodities are not going to, I guess, go higher and go to where their destiny is. What I'm telling you, or what my opinion is, I'll stick with that, is that this is structural by nature. It is structural. A recession can't cure it. Money printing won't cure it. And if we have this many humans on Earth, we're going to have to go through higher prices, irrespective of the timing of when that occurs. And I was reading through Twitter, Mark McGuire, I don't know if he's the real Mark McGuire, but he says, with this system, we have deflation follows stagflation. Well, technically, deflation follows every single bear market in real estate, in the housing starts. And the housing starts are the driver of it. And that's my opinion. We've never had, maybe I'll pull this up. We've never had a blowout recession or deflation. Deflation is what he called. I'm not going to say recession. We've never had a deflation without a housing market crash. What I have is the housing starts, new privately owned housing starts. Every time this goes up in an expansionary phase of real estate, we've never had a recession. We've come out of recessions. The deflations occur after the housing starts decline. And here we are on the right-hand side, and you can look at every single, you can go all the way back to 1960, you can go all the way back to the long-term housing markets in the 1800s. If the housing starts are going up, it is a credit expansionary phase. You don't have deflation in a credit expansionary phase. That's contradictive. You can't expand and contract at the same time, by definition. So rather than me and everyone trying to predict when this thing's going to come, what I'm going to do is I'm going to look at the housing starts. And if the housing starts start to decline and go below the average, then you have the possibility of a recession if it doesn't recover. The thing that's weird, and I see a lot of people, they're posting on Twitter, and they're talking about the recession that is driven by high oil prices or high energy prices, more particular high oil prices. Mark McGuire, I'm not picking on him. He posted this, and this is what it is. It's a surge in energy prices suggest high probability of recession, and we've come on up and we've surged in energy prices. And what I'm saying is, one, I don't know the exact future. Two, what I am saying is this is structurally, we're in a structural deficit. The structural deficit in oil may cause a short-term recession, but it doesn't fix the structural problem in oil. It doesn't fix the prices. We can't we can't not bring on more oil and fix this for a while, I think. And the demand, what I think, let me piece this together real quick. I think that is not a leading indicator. What that is a symptom of a problem. The problem being that we run into more homes coming into the system, and then inflation floods the system. Inflation in itself puts everything in supply shortages, so to speak, because you've got more money in the system than you do supply of goods. So you have these supply shortages that always pop up, seemingly, with very high inflation. That, in my opinion, is not the driver of it. It is a symptom. So the difficult part is that the driver of it, or is that just by happenstance that every time we go into these large housing real estate expansionary phases that goes up and things start to kind of implode because the affordability of a lot of things goes down just in general because your commodity prices go up at the same time. Irrespective, if this does cause the housing starts to decline and we go into a recession, guess what's going to happen right after? It's going to all go back up again. It won't permanently stop it, is what I'm saying. So I can see that people are getting worried in some of the posts, not necessarily on YouTube, but in some of the Twitter things about a recession occurring and that we're going to have this blowout deflationary crash. That could be the case. It could be, but we would see the housing starts fall below its average, and that hasn't happened yet. There are things where supply shortages are impacting the finishing of new homes. So that will be something to monitor and watch. And obviously on the channel, we're going to monitor all this and watch it. So I just wanted to comment on the recession portion and things blowing out. Now, if this was a blowout recession, if this was like the end of all peaks and that oil was going to peak and all this other stuff, we should see it in the charts, shouldn't we? We should see a bunch of people positioning for this. If this big old deflation's coming, we should see the positioning of it. So let's take a look and see what the positioning is. I mean, you've got me here. Let's use me. So if we were going into this thing, and a lot of people, I guess what they were claiming is, they were claiming that the oil price spike was like 2008. It's like 2008. We've got an oil price spike. Well, I'm going to show you a bunch of things that don't match with the 2008 narrative. So I'm here to break down all of those. I'll call it, they're not true. So, and I'm going to do it using technical analysis and charts. I know, crazy, right? So this is our data. Our data is just charts from specific companies. In 2008, we were in a massive, I mean, this was at the end of a huge bull market move in potash. Potash is a fertilizer company, or it's a fertilizer. This is a company in it. Oh, this is Denison Mines. I'm going to start with Denison Mines. I thought I had Intrepid Potash up. This is Denison Mines. Uranium took a huge blow-off move and peaked in 2007. Here's your big blow-off move. Liquidity entered the system. We had a short, small deficit in uranium, and this thing blew up to the upside. Does this look like 2008 on the right-hand side here? Does this look like 2008? I don't think so. Now, that's one uranium company. The entire uranium companies, they all look like this. If I were to pull up like CCJ, here's your big blow off top, and the big move from 2000 all the way onward. This was that credit expansion phase of real estate, the money flowing into the system, money flowing out of stocks and bonds and into, this is the 2000 NASDAQ bubble in this region down here, and money flowing into these sectors based off of liquidity flows. Now we've got a molecule crisis on top of liquidity flows. This is rocket fuel for, this is going to make this, in my opinion, this is going to make this over here look like a warm-up. Because if we come and we get in this large short squeeze with a bunch of liquidity in the system and a large rotation of money occurring in a paradigm shift of a credit cycle that's ending, I don't know what that's going to look like. It's going to be much different than this little guy here. But this doesn't look like it's peaking. This looks like it barely just broke out of its pattern and is starting to move higher. So uranium doesn't look like it's peaking at all. It just looked like it barely broke out of its pattern. And then if you look at oil, if I were to look at XOP, I'll just use XOP as an example. XOP is just breaking out of its downtrend line. There you go. Just out of its downtrend line. It's just breaking out, and we're about to break out of this resistance line. And if you zoom in, we don't have large down candlesticks and small up days anywhere in here. They're all big, large up candlesticks with small candlesticks hitting a little resistance line. That doesn't look like a topping pattern to me. That doesn't look like anything bad's about to happen. That looks like we're at the beginning of a large launch that will happen. If you look at gold, and gold is a precursor. If we're going to have deflation, this thing will be peaking and rolling over. Does that look like it's peaking and rolling over right after a fresh break of a move higher? It sure doesn't look like that to me. And yeah, we're having a little bit of a pullback after we hit our head on all-time highs. But that doesn't look like it's peaking and it's at a top. And you can look at any of these, here's a royalty company. That looks like it's ready to break to fresh, trying to go after fresh all-time highs at some point here soon. On a large pattern break to the upside that had a little bit of consolidation. This looks like it wants to launch higher. That doesn't look like a top. Crude oil itself, you look at the commodity itself. This thing's been rocketing higher off of a fresh, big chart break pattern here. Broke to the upside and it's running. That doesn't look like it's a top. Yeah, we got a little bit of a pullback here, and I think we might rest a little bit before moving higher. Maybe not. We'll see. And we could even pull back and do a return move to $97, and I still wouldn't be scared. We could pull all the way back another $10 per barrel, and I would just be a buyer. It's a breakout and a return move. I mean, that's like classic technical analysis textbook, technical analysis trading. And I can go into all these other areas, and to me, it doesn't look like there's a topping pattern in it. Now, another one that's a leading indicator is copper. Copper, if we were in a crisis, what you could use is the copper to gold ratio or copper itself. There is a peak. We do have some wicks up here in copper, which means we could pull back in it. But usually copper does a beeline lower, and we'll see if it does that. If it does that, I will change my mind. If we start beelining lower. And let's go to the ratios real quick. Here it is. Copper to gold ratio. Usually when this is increasing, this is where it's been going sideways here recently. Usually when this increases, we're A-okay. Now, if this starts to decline quite rapidly, and it does, there is some large down candlesticks here, and if this thing blows out to the downside and starts running lower, what we want to look at next is your interest rates. Your interest rates, if these blow out to the downside, if this blows out to the downside, then I would worry. That means people are running to bonds for safety. They haven't been doing that. They've been selling their bonds. So, I mean, this was the last one from 2018. It just started lowering like this. That's when you have to worry. And there's your crash right before interest rates. People were running to interest rates in January, February. It was just diving lower. And people knew that a crash, like something bad was going to happen. And then in March, the crash happened. So they dove into bonds. We're not seeing that. So I don't think any recession, at least by looking at the bond market, by looking at a lot of these stocks and the patterns of all these commodities, I don't see the crash, at least not yet. It's not, no one's no one's moving money in a way that scares me. And that's what you look at. You look at all these things to see how money is flowing in and out of sectors. If money's just pummeling into bonds, you know something bad's happening. So you don't want to get scared if there's no reason to be scared. You have to see it in the markets first. And the markets are quite slow. This is going to dive down for like a month or two before something bad happens. So I don't think we're necessarily close. And I don't want to be in the game of making predictions. I'm in the game of looking at it because we have time and we can react with that time. So I don't think that I don't think that there's a crash yet because I don't see it yet. Doesn't mean there isn't one in 6 months or a year. I have to see the data before that happens. And that's kind of how I look at things. I have to see it before I believe it. So I wanted to end there. Give me a thumb up for the content, guys. If you like this type of analysis, definitely give me a thumb up. Subscribe to the channel if you haven't. And thank you for listening. This is Finding Value.